This was supposed to be a live webinar this morning, but alas, the technology failed me. So here it is as a pre-recorded video. Stay tuned for a great Litecoin setup and training on the bear and bull flag pattern. Hi everybody, this is Tim from Trading Strategy Guides. It's morning and it looks like it's going to be another hot one in the Dallas area today. Isn't it great how I start out with talking about the weather? Anyway, good morning, afternoon, evening, or night, whichever is appropriate for your time zone, and pour yourself another cup of joe. That's coffee for those of you who don't get it. We're going to look at one of my favorite setups. In fact, if you follow my analysis videos on Monday and Friday, you're bound to see the bear flag or bull flag setup. I use them often. We'll also talk about our open trades, and I'll have a trading maxim from the archives. And I'll also answer your trading questions. Plus, another bonus, I've been saying that I don't do this much, but this will be 3 weeks in a row that I've given you guys a bonus trade setup. So I guess I can't say that anymore. Anyway, I'm going to show you a great setup on Litecoin that could possibly trigger later today. First, let me explain a bit about what happened this morning. This is my first time using a live stream encoder for my webinar rather than the now discontinued Google Hangouts. I did it successfully last week in testing. What happened this morning? Well, I don't know yet, but I'll get the kinks worked out in time for next week's webinar. I hope you'll forgive me and bear with me on this. And I will be answering some questions you guys asked in the chat. Remember, you can speed this video up by clicking the gear icon in the lower left of the video and selecting a new speed. Also, don't forget to click the subscribe button, then click the bell for notifications. Let's start by looking at our new trade triggers. Our Ethereum setup has triggered to the upside right here with average volume. Not extra, but definitely hit the average. It's not too late to get into this. I'm in this at 233 with my stop loss at 210.05 and my first target at 248.30. If this closes back inside the triangle down here, we will close this for a loss. And the Crude setup has triggered. It hit average volume right here on this close outside below the triangle. I got short at 53.63 and it's hit the target this morning. Last time I looked at it, it was up in here somewhere. So that's nice. I was going to say, if this closed back inside the triangle, then I would close it for a loss. But I will be moving my stop down here to 53.63, which will be break even on the second half. This automatically closed half of this trade right here at 51.73 for profit. We'll let this go. I did want to talk about why I close trades for a loss when they get back into the consolidation. And I do that because my reason for entering the trade is gone if the trade head fakes and then goes back into the consolidation without hitting the target. The plan here is for an explosive move when price exits the pattern, which should drive it quickly up to our target, which it did here. I mean, it closed here yesterday, and today it's hit our target already. So if that doesn't happen and it goes back in here, I want to be out of the trade. Yes, sometimes it will go back and hit the target after closing inside the pattern again, but it's no longer a high probability trade. So I don't want to wait for it to do that. My money is better spent on other trades that have the momentum to go straight to the target. Okay, Urban Outfitters. Here you go. Urban Outfitters hit our target on Monday, and yesterday it popped up here and took out our break-even stop. So I'm out of this. The profit on this is $859 on this first half, 0 on the second half. So I'm done with that one for now. And pretty much the samesies on the Renault trade right here. Hit our target on Friday right here, and yesterday it popped up and hit our break-even stop loss. So profit on the first half of $848, and I'm also done with this one for now. S&P E-mini, We got into this thing over here. It hit our target on Monday, right here. And then this meltdown happened, and we were in the right direction for that bad boy. And after this meltdown, I moved this stop down to just above 50% of this candle at 28.90. This morning, it popped up to within 75 cents of that stop loss right there. I'm still in this, and as soon as it makes a lower low, I will move the stop down a little bit more. So right now we've got a total of about $2,500 profit locked into this. So this was about $850 or so on this, and the rest of it is locked here at $61.75. And here you go. Ryanair came down and hit our target on Monday, popped up yesterday, didn't take us out, popped up some more today, and we are out, break even on the second half. So we probably made about $850 profit right here, and we're done with this one. Okay, I promised you a setup on Litecoin. We've been having some great consolidation setups on the cryptos over this last week or so. This is a continuation triangle, roughly right here. Yeah, very roughly. This has been around since mid-July or so, but it's got a lot of hits on each side. Got a couple down here, one here, about 3 more here, about 4 up here. So this setup is simple. We will buy if we get a daily close above the triangle, or we'll sell if we get a daily close below the triangle. Now earlier this morning this was actually below the triangle here, but it's pushing back up. Keep in mind this closes later in the day. This closes about 8 p.m. New York time. So you'll have to watch this at a different time you would look at the stocks and Forex. But watch for this close, and if it closes down below here, if there is sufficient volume, which of course there isn't yet, then we'll take this short. We want to see at least average volume on this trade for a full position. If you've got at least 75% of the average volume, you can open a half-size position to reduce risk. Calculate that number by taking the volume and dividing it by the volume average, and you should get at least 0.75 on your calculator when you do that calculation. If you don't have at least that, don't enter the trade. Stop loss will be 1.5 times the ATR. The ATR is the average true range. This is the current ATR number. You'll want to look at it when the candle breaks to find out what it is then. Multiply that by 1.5, and that will be your stop loss. Multiply it by 1, and that will be your target. If, after entering the trade, we get a candle that closes back inside the triangle, we'll take the loss right then and not wait for it to hit the stop loss. Remember I said earlier about shutting down the trades early if they aren't working as intended. Our intention is that a breakout from these patterns should be explosive and hit our target fairly quickly. If the momentum goes away, we want to shut down the trade without taking a full stop if possible. When the price hits our first target, we will close half the position for profit and set the stop loss to break even on the remainder. We will then follow stops as price moves in our direction until the market takes us out. Now, I love saying this to you. You guys are all grown up. I'm not your mama. I'm not telling you what to do. You can do what you want to, okay? I'm just telling you how I handle the trades, and I've had some success at it. If you want more details about that, look below this video for a link to my trade management video. Okay, let's take a look at the strategy here. You know, I've said this lots of times. A bear flag is one of my favorite trading patterns. I use it in ranges and triangles for just about everything. I'm going to show you the details of the bull and bear flag patterns. You purists will be happy to know that this is a price action strategy. You probably know that I have my little twist on it, but I'll show you the pure price action strategy first. I'm going to start by showing you the bear flag and its twin, the bull flag, but we're going to start with just the bear flag. Just know that everything that applies to the bear flag applies to the bull flag, but upside down. A bear flag is a price action pattern that looks like this. It starts with this flagpole right here because, flag's got to have a pole, right? The flagpole is a strong trend into the pattern. At some point in that downtrend, the price action will consolidate in the form of a narrow uptrend channel. That's the flag. We anticipate that the trend will continue when the flag is complete. This is what it looks like in real life. You see this strong downtrend right here, then the uptrend channel, which is the flag, and then a continuation of the trend. Why does the flag form, you ask? Well, I'm really glad you asked that question. More people should ask good questions. This is what happens when supply and demand have moved hard towards supply. So much so that the price cannot retrace very much after that downtrend, and it gets stuck in a narrow uptrend channel with buyers trying to drive it higher and sellers saying, "Oh, no, you didn't." I call this a knife fight. Nobody wins in a knife fight. Everybody gets cut, right? At some point, the overabundance of supply finally takes over and the price continues in the downtrend. Now that you're familiar with the pattern, let's talk about the strategy. I think that you'll find this strategy works very well on all time frames and all markets. Step 1, look for evidence of a prior bearish trend. For a valid bearish flag, you need to see a sharp decline. Boom, right there. That's about as sharp as it gets, right? Step 2, identify the flag price formation. The price action needs to move in a narrow range between two parallel lines. You should be able to draw parallel lines above and below the flag. Ideally, you should have at least 2 points of contact above and 2 below. But remember, a line is never just a line, it's always a zone, so perfection is not necessary here. If you've got wicks that are sticking out a little bit, you'll see me draw those all the time. I do try to make sure that all the candle bodies are contained within the flag. Just don't get overly OCD about making sure your flag is perfect. Step 3, sell at the closing candle that generates the flag breakout. So in other words, sell the first candle that closes below your flag. Right there. Step 4, place the protective stop loss slightly above the flag. As you know, I'm teaching you strategies from the Trading Strategy Guides blog. I usually start by showing you the way the blog does the strategy, and then I put my personal spin on these strats, particularly on strategies that I use regularly like this one. If you've followed my analysis videos, you know that I don't use price action to determine my stop loss. But for the purposes of this initial explanation, I'll explain this the way the blog explains it. I just don't want anyone confused if I don't use these strategies exactly as they're written in the blog. With that said, put your stop loss a few pips above this flag. The number of pips will vary based on the time frame you're trading. If you're on a 60-minute chart, you may want to use 5 to 10 pips. But a daily chart, you may want to use more like 25 or 30 pips. Step 5, the take profit target equals the same price distance of the flagpole measured down from the top of the bearish flag. This is the textbook profit target for this pattern, and you should measure the height of the flagpole and use that as your profit target. So that's pretty straightforward. You measure from here to here, and that's your profit target. So you measure that same distance from the top of the pattern to here, and that's where you take profit. So obviously your profit, since you're actually getting in down here, is not going to be that whole amount, but that's okay. Okay, I've shown you what a bear flag looks like, so I wanted you to see a bull flag. All the same rules apply, but you're going up instead of down. So you can see this nice drive up. It's not as positive as that drop, but this is a nice flagpole. This is the pullback in the parallel channel. This is the breakout. Buy on the close of this candle. So really this should be pointed right there. And your profit target is 153 pips right up here. And your target's hit roughly right there. Now, I promised to tell you about my own personal spin on these setups. And so I'm going to do that on this chart right here. I'm not sure if I've shared this setup in a video yet, so you might be able to think of this as another bonus trade setup. This is a daily chart of the Australian dollar New Zealand dollar pair. You can see this has a nice uptrend into it right here. and then it pulls back into a downtrend in a parallel channel. Now it's been in this pattern since mid-April, right in here. So I like it. I like patterns that have been at it a long time. Now this thing is pulled way back. Now I think I mentioned one time that I like to pull Fibonacci on the flagpole just to get an idea of how far the flag is pulling back. Now typically these things will break when they hit the 38-ish or 50 or 60%, 62% Fibonacci level. But this has retraced all the way back to the 100%. So it's a bit long in the tooth, but it still shows all the things I like to look for. Anytime a consolidation happens, I want to see a decline in the volume and volatility over the course of the pattern, or at least near the end of the pattern. This is an indication of trader boredom. The volume, of course, is simply the number of dollars being traded in this particular market, or in the case of Forex, the number of trades that are firing off on this. The volatility is simply the amount of busy movement of the price within the pattern. I use the average true range to measure that. The ATR is the average range or length of the last 14 candles. Now you can see that the volume and the volatility have popped a little bit in the last few days. So people are getting kind of excited about this. I'm going to keep my eye on this, but right now it looks like it might end up breaking to the upside, just like we would anticipate. In any case, I look for the volume and the volatility to confirm the pattern. The more the volume and the volatility drops, the more explosive the price will be when it breaks out of the pattern. Now, the other spin I use is something I explained earlier when I was looking at the Litecoin setup. I use the ATR to determine my stop loss and first target. So this is the modification I would make to the strategy. My stop loss would actually be 1.5 times the ATR. In this case, the ATR is a little bit over 64 pips. Now it hasn't broken out yet. We'll have to see what that number is on the breakout. But we will take that number, multiply it by 1.5, and that's where the stop loss will be down here. Then we'll multiply that number by 1, and that's where our target will be. And the target and the stop loss will be calculated based on the actual entry. I would take half of the position off when it hit the first target and move the stop to break even on the second half. I would then close the second half as suggested by the strategy. So in this case, we would want to measure the flagpole here at 440 pips. So our target would be from the bottom of the flag, again, 440 pips. So our target would be right here at the top of the flagpole. The other small modification I would make is that I would close the trade for a loss if the candle closed back inside the flag. I love to do that because it keeps my losses small, and once it goes back in and closes back inside consolidation, then as far as I'm concerned, the trade is done. And that, my friends, is my spin on the bear flag strategy. I'll put a link to the blog entry for this strategy below the video. Now, you guys are back testing and forward testing the strategies before using them, right? And why, you may ask? Once again, I'm glad you guys keep asking these great questions, because you need to have confidence in your strategies so you'll stick with them even when they're going through a drawdown period. So test, test, test. Okay, and this is the point at which I would be asking you guys if you have any questions. So this is the point at which I'm going to answer some of the questions that I got in the chat earlier. Tim Benji asked, was I caught in the recent market sell down? Well, actually, yes, I was, but I was caught on the correct side of the market sell down. I know everybody was looking at the market and saying bullish, 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 so everybody was long. And, you know, I'm not patting myself on the back. Actually, I broke my arm patting myself on the back, but not really. I would look at the chart, and I saw the chart breaking down, and so I was short. I don't care what the news says. I don't care what anybody says. I follow the patterns on the chart, okay? And if you watch my analysis videos, you'll have a really good handle on exactly how I do this. But I look at the patterns on the chart, and I enter then. I keep my stops small so that if wacky market move happens and it's against my trade, then I'm stopped out. And I'm stopped out, I take the loss, and that's the end of it, you know. I don't worry about it. I don't sweat it. I don't care. It's a done deal at that point, and then I look for the next opportunity. So in this case, I was caught on the right side, and I got like a 15% windfall profit in my Forex trading account because I was on the right side of all the about, let's see, 3 or 4 Aussie pairs, 2 Kiwi pairs. I was short on all of them, and they just moved huge. I mean 300 or 400 pips on each one. So I was also on the correct side of the S&P 500, and hopefully we'll be able to collect some more from that one. Next question, Maheen asks if I have opinions on the ongoing bullish gold trend. Maheen, I think as long as the stock market is tanking, you can probably expect gold and other stores of value like it to continue going up. But caution, watch the chart. Don't allow bias to influence your trading. Okay? I mean, if bias is part of your trading strategy, then that's fine. But trade what you see, not what you think. Maheen went on to ask, is one of the factors pushing it up the whole Iran-U.S. tensions? The truth is, Maheen, I don't really pay that close attention to the news. I mean, I've watched the news. I think a couple of analysts were saying that they thought it was the China-U.S. trade war. But political unrest anywhere in the world has an effect on the market. Traders always run scared when something happens, and they take their high-risk trades out and they put them in low-risk markets like gold. And I think cryptocurrencies will also fall in the category of safe stores of value. I know people like to buy Swissies, Swissy francs. So yeah, anytime there's any kind of global tension, you'll see it show up in the market. Simbenji said that he thought I was taken care of and that I got quite a few short trades even though the market was bullish. Maybe I was born to be a trader. You know, Simbenji, it's possible that I was born to be a trader, but I didn't do it for most of my life, and I wasn't successful for the first 7 or 8 years of it. So still a whole lot of work went into it, and the biggest amount of work is maintaining control of your emotions. Simbenji asked, I notice your style does not seem to bother about the market or the sector the stock is in. You just trade based on the patterns. Absolutely. I'm just looking for stocks or markets that are moving. As long as they're moving, and they can be moving in a consolidation. In fact, you know, that's really what I look for. But I look at various news items, and I've linked most of those news items below all my videos. Couple of emails and a website or two that I look at to find out, you know, what stocks are in the news, what markets are in the news, and those are the ones that I look for patterns on. Mudiaga just got the ATB sniper indicator some weeks ago, and he found that some trade signals on the M15 are contrary to that of the H1. Okay, first of all, the market breathes. It breathes in, it breathes out, and it will not continue going in the same direction at all times. And what happens is you start seeing these turns or these breaths on the shorter time frames first, because when you're measuring the amount price has moved over, say, an hour's time, you'll find out that there can be a whole lot of up and down movement in the 1-minute chart that will never show up on the 1-hour chart. So if you're taking a trade signal on 15-minute charts or 5-minute charts or whatever, you'll find out that you may get a lot of signals in both directions that don't ever actually show up on the hourly chart. Or you might get a trade signal long on the daily chart and short on the hourly or the 4-hour chart, because price may be in a pullback from the daily direction, or like your example, the 15-minute is in a pullback from the direction of the hourly chart. But if you compare a 15-minute chart to a 1-hour chart, you'll find out that there can be a whole lot of motion on the 15-minute chart that's contained within the hourly chart that just never shows up at the end of the hourly chart or the end of the hourly bar. So consequently, you will often get trade signals in different directions. That's also the reason why you can't look at one person's strategy who's saying, well, I'm going long on the euro dollar, but your strategy is saying short on the euro dollar, and so you don't take your trade because some other person said they're going long on the euro dollar and you think you're wrong for some reason. You know what? You can both be right. I know that sounds crazy, but I can go long on the euro dollar and you can go short on the euro dollar, and both of us can hit our target because it depends on how we manage our trades. If my stop's bigger or way out past your target, then you can hit your target before I hit my stop, and then price can reverse and go down and hit my stop. So I can be trading on daily charts and be going short, and you could be trading on hourly charts and be going long, and we both can be successful at that. I hope that answers your question. I didn't want to try to type all that because it's a little bit more difficult to explain in typing. Okay, Mudiago asks, what advice would I give to someone on how to grow a small account, because I find it typically difficult. Trading a small account is tough. I mean, a lot of people, think that would be easy, but it's not. For starters, your profits on your trades are going to be tiny. And so it's kind of difficult to be excited about a 25-cent win or a $5 win or even a $25 win, depending on the size of your account. But every win contributes to making your small account a larger account and allows you to trade larger size. The thing I would tell you is, do not over-leverage yourself. Do not risk more than a couple of percent on any one trade. No single trade should make or break you. So the problem with trading a small account is maintaining your risk. You're going to only be able to trade certain things. Forex, for instance, is great because you can trade micro lots that risk about 10 cents a pip. If you have a really tiny account, say a $5 or $10 account or a $25 account, then you can trade with a broker like Awanda, and I only say Awanda because I've been with them for a very long time, and that is where I went when I had already blown out my big money and was having to trade with small money. I went to Awanda because Awanda, on their native platform and also on TradingView, will allow you to trade 1 unit of currency or 1/1000th of a micro lot. So you can trade with a 1/10 of a cent risk per pip. So you can actually maintain a 2% per trade risk and still have a decent stop loss. The problem with trying to trade a larger trade size is that you have to keep your stop losses small. So you're going to need a strategy that works with very small stop losses. Yes, Mudiago mentions that hasn't been able to catch the big trades because they typically come back and stop him out before actually traveling in his direction. And that's the problem, is if your stop loss is too small because you're trying to maintain your risk, then you're probably spitting in the wind because you'll just end up getting stopped out all the time. And Mudiago now asks, how do I cope without looking at my open trades? The truth is, I don't. I look at my open trades all the time, but I've just gotten used to following the rules. I'll tell you what I have the biggest problem with is when I had all that big windfall earlier this week, my big problem was should I close this while it's up? Instead of letting it pull back and letting my exit indicators tell me it's time to get out now. And the truth is, I actually did close a couple of them because they were up so huge that I just couldn't imagine waiting for my exit indicators to tell me to close. So I actually was patient for a long time on those trades, and I actually caught them near the bottom. So that turned out well, but it could have turned out poorly because at one point I was up about 5% on my account, and that's when I started thinking about closing them, and they ended up pushing up until I was 15% up on my account. So I am glad that I waited, but yeah, I did violate the rules a little bit. But I do not have that problem if the trade's going against me. I will follow the rules strictly when the trade's going against me. One thing I want to recommend to all of you is you need to read Trading in the Zone by Mark Douglas. You'll find that on Amazon. I'll put a link below the video. That book will help you with the most important thing you need to learn about trading, and that is trading psychology and discipline. Following your rules strictly is the only way that you will be successful as a trader. So I reread that book a couple of times a year. Great for my psychology. It's great to get me excited about trading again. Okay, guys, that's all the questions that I have to answer. So let's have a look at today's trading maxim. A maxim is a general truth, fundamental principle, a rule of conduct, or just a proverbial saying. These maxims come from various sources, books, the internet, friends, coaches, teachers, or other acquaintances. The purpose of my maxims is to motivate me to discipline. I suggest you start your own list of maxims to help in your trading, things that you can say to yourself while you're trading to make sure you always do the right thing. Feel free to borrow from my list. Today we're going to dig into the archives. Tim's trading maxim number 8. Your first job is protecting your trading account. Interesting that I had the questions about trading a small account. Here are some questions I have for you. What happens if you don't protect your trading account? It goes away, right? Then what do? You trade on demo, or you trade a $5 account, or whatever change you can put together from your pocket. You definitely don't want to trade scared money. You don't want to borrow money. You don't want to trade your mortgage money or your rent money or your food money or your gas money or whatever. How long would it take you to put together another trading account? What are you going to do in the meantime? Your most important job is to protect your trading account. That means you don't risk it unnecessarily. Risk is part of the job, but stupid risk is not part of the job. So to protect your trading account, that means you don't do stupid things like overtrading. And look, by overtrading, that doesn't mean taking too many trades. I kept hearing people say, well, you're overtrading, you're overtrading. Well, what did that even mean? I didn't know. Okay? I finally figured out, I either figured out what it meant or I just defined it for myself. If your strategy calls for you to take a trade signal, you take it. Bam. I don't care how many there are. As long as it fits your strategy and it follows your rules, you need to be in that trade. No, overtrading means trading too much size. You never risk more than 2 or 3% of your account on any one trade. Most of you know that I only risk 2% per trade because no trade is 100% sure. So you're not being cool or edgy by taking huge risks. You're just being stupid, okay? Sorry, I don't mean to be offensive or anything. I'm just always about dishing out tough love, okay? Also, I'm not just preaching about something I haven't experienced. Yes, I have blown out 3 decent-sized trading accounts. I'm not going to talk about how big they were, but they were healthy accounts, you know? Thankfully, my wife and I both had very high-paying jobs. She's a nurse. I'm a programmer. So when I was learning to trade, we were able to restore these accounts. But I was stupid, and I sweated every single trade I put on. I got dry mouth and sweaty palms That is a bad sign. If you get dry mouth and sweaty palms, you need to size your trade down. If you're sizing it down a whole bunch, I mean like to 0.25% risk. Size it down. You can gradually increase it as you get acclimatized to the additional size. It's a bad sign if you get dry mouth every time you put a trade on, okay? Protect your account. Okay, remember the steps for the bear flag trading strategy. Number 1, look for evidence of a prior bearish trend. For a valid bearish flag, you need to see a sharp decline. Number 2, identify the flag price formation. The price action needs to move in a narrow range between two parallel lines. Number 3, sell at the closing candle that generates the flag breakout. 4, place the protective stop loss slightly above the flag. And 5, take profit target equals the same price distance of the flagpole measured down from the top of the bearish flag. And remember, if you don't have time to analyze charts, or maybe you just don't even want to, Trading Strategy Guides has the Strike Trader Elite and the EFC Trade Signal services. You'll get Forex trade signals on a dozen or so pairs on different time frames, all based on the Strike Trader Elite or the EFC system. Look below the video for a link to the free signals on the Telegram application. I'll also post a link down there to my video that explains the Strike Trader Elite system. Hey, let's do this again next week. Well, let's not do this. Let's have an actual live webinar at 9 o'clock U.S. Eastern Time next Wednesday. I will endeavor to get all the technical details worked out. Remember to watch for my analysis videos on Monday and Friday. And as always, thanks for watching. Thanks for subscribing. And if this webinar helped you, please hit the thumbs up below. Have a great remainder of your week, and I'll see you next time.